Tonight, Karg Island, Iran. Is Trump even shooting straight with us? What about the Strait of Hormuz? And how long are we going to have to endure this pain in our portfolios because of what's happening in the Middle East? Capital Growth, our benchmark program, gets a full review tonight in the first monthly cycle. And your transition from growth to income, from working years to retirement years, we have you covered with a full segment tonight on how we at CB3 handle that for you. It's Thursday, April 2nd from Chicago. I'm Charles Brown, your portfolio manager, and this is CB3 Live. We're so glad you're with us tonight. It's a week early, and because I'm traveling next week, we needed to move it up a week here into Easter week. Sorry about that, but it was something we just had to do. Hope you'll stay with us. We've got a great show for you. Let's talk about what's happening out there and what is going to happen with this war. We are in the Wall Street war zone. Today looked like it was going to be another big down day, and then it came back and actually closed just a little bit positive, but unbelievable frustration in the market because the bulls are trying to take this higher or at least maintain it, and the bears are trying to take it lower, and they succeeded quite a few days this week. But on the whole, I think the week did finish slightly positive because of the very strong days on Tuesday and Wednesday. So it's just an interesting time. Geopolitical and macro crazy stuff with Iran, Karg Island, oil at 108, actually now at 111 in the May contract, 97 in the June contract. I'll get into that more later. Strait of Hormuz, definitely in the news, being able to move ships freely in there. What does all this mean for your portfolio? And CG, Capital Growth, this is the quarterly review. You guys sent in surveys saying you wanted to hear quarterly reviews of each of our programs, so we're going to do that. And I'll get to that schedule later on in the program. And then the retirement income transition. We've had this request for years. I usually do this every couple of years, but as all of us have gotten older and we'll be transitioning from growth primarily to primarily income, this seemed to be the time to do a pretty extensive segment on that. So what is going on in the market? Obviously down on the year, the S&P, the NASDAQ, the Dow, the VIX is very elevated, although down from 30. All right, West Texas crude, as I mentioned earlier, 110.90 was when I updated it on the chart here. Brent, which is the European standard, a little bit higher. And the 10-year is declining because there's a migration to fixed income. Fed fund rates are on hold, 3.5 at 3.25. The earnings reviews. This is a just kind of average report. They call it Goldilocks, not too hot, not too cold. 73% is the long-term average, and that's where the quarter four, remember, we're just starting the second quarter, and we'll just start on the second or first quarter earnings reports. But the fourth quarter is what we just finished. There's still technically 2 stocks outstanding when I had this report drawn, but we're right at the average at 73. So that's fine. You know, in this wartime market, it could be a lot worse. What's the preview though for next quarter? So look at the first quarter on, or pardon me, the review of the fourth quarter. It's kind of tricky, guys. The first quarter, we spend the time getting to know and getting to assess the fourth quarter earnings. But what we're looking at for the first quarter earnings on the right-hand side begins in mid-April, but there are already companies that are starting to respond, and I'll show you that in the next slide. Banks are always first. JP Morgan, BOK in our portfolios will have a substantial impact. And so the oil shock, the late quarter one, really in all of March has been a shock because on February 28th on a Saturday, Trump just started bombing Iran, and that's pretty much put the entire market on I don't know, what do you want to say, stilted legs here in the month of March. So the energy sector obviously strong. We had migrated into some energy stocks. We've added more in this next review. We'll tell you about that in the second segment. Tech and AI continues, but the fundamentals are intact. Still rotating some out of that. We've lessened positions there. Again, more in segment 2 on that. The bar's lower. I think the consensus has pulled estimates down, although what's it looking like going forward? 78% so far, only 18 stocks. So obviously when I see you in mid-May, there'll be a lot more reporting than that. But right now it's off to a pretty good start. Financials at 100%, technology at 100%. We really want to see consumer discretionary. So the 3 big sectors, consumer discretionary, technology, and communication services, when those 3 are leading and strong, it almost doesn't matter what the rest of them are doing. So we want those to be strong, all right? And we'll be watching this page in the next report. So here we are with Iran, Kharg Island, and the oil war. You see the prices on the right-hand side. Americans don't like high oil prices. And why? Because it means we can't spend on discretionary things that we would like to spend on because we have to spend more to fill our cars and trucks with gasoline. And even when these prices come down, eventually when there's stability with the Strait of Hormuz, you'll be hard pressed to see those retailers out there want to drop their prices until their competitors do. And then they have to drop it to match. So Kharg Island handles 90% of Iran's crude oil exports, about 1.5 million barrels a day. Got to get just wrap that around your head. 1.5 million barrels from this small island in the middle of Hormuz. Okay. 20% of the global oil supply is at risk, and that is why the market has been so volatile. Although I guess maybe 10% of our oil comes from that area. And if we were able to fully switch, or when we are able to fully switch to US produced oil, we're not going to need it at all. So why are we so concerned about the Strait of Hormuz? Why aren't the European countries concerned? Well, or the Chinese? Well, the Chinese are in bed with Iran, and that's why. They know that their ships are going to be able to get through. But Europe should be a lot more concerned because their economies are at much greater risk than ours is. So Trump threatens to obliterate Kharg Island if the strait is not reopened. I'm guessing you saw his press conference last night, and the market sold off promptly after that. So why is that? Brent crude. So there are 2 standards. There is West Texas Intermediate, which is the domestic or the US standard, and then Brent crude, which is the European standard. There really isn't an Asian standard per se. Probably it's Brent as well. But you can see from the chart here that Brent is up nearly 50%. I think that's down a little bit from where it was because these slides would have to be updated literally 10 minutes before the show, which is hard to do. So the oil producers, energy infrastructure companies benefiting directly, XLE, GEV, which are in our CG program. We'll talk about that in just a few minutes. Defense spending accelerating, BWXT, DE, all benefiting from that, also in our CG program. The Fed is forced to look through this shock because they can't cut into supply-driven inflation. Fed is in a really tough place here, and they're losing their chairman. Or are they? Kevin Warsh has not been approved by Congress, by the Senate, I should say, because the House has no say-so in it. And if he's not approved, then he will not be able to sit in and be the chairman. And in which case, Jay Powell would continue to be until the Senate confirms Kevin Warsh. So just one of these political wranglings. So we're positioned pretty well for this. 7.5% of our entire portfolio is in energy. And the SPY puts, as you know, protect us to the downside. That really came in handy this month. So the Fed's impossible position here is the Fed funds rate 3.5 at 3 3/4. That's a lot to say. 3.5 at 3 3/4. There we go. All right. So held March 18. It's on pause. Trump, as you know, would like to see this about 2.25. That's not going to happen this year or probably even next year. The PCE inflation forecast at 2.7%, up from 2.4, but that has only happened because of this last month and the rush of crude oil need and routes being blocked, obviously, in the Strait of Hormuz. But they tend to move in sync. these retailers and the oil companies will raise prices if there's any kind of political, geopolitical angst, if you will, anywhere in the world, even if it's not necessarily affecting their clients. All right. So we've gone from an expectation of 2 to 3 rate cuts to 0 to 1. There's actually almost a 40% chance of 0 rate cuts. That would not be good to finish this year. That means single digit returns, if that. If we had a single digit return at this point, I would actually be pretty thrilled with an 8 or 9% return, because that would be near the norm. But the 20 or 15% of previous years, probably not in the cards. All right. So this oil shock, as I just said, is supply driven. It's driven by the drama happening because of this war. Labor market is softening, meaning unemployment rate is slightly bumping up, but inflation at 2.7 argues against rate increase. Excuse me, a little tickle in my throat tonight, so I hope I don't have to do that too often. Anyway, Powell's term expires. The new chair could shift policy dramatically. We will see if that happens. The employment scenario, now this is an unusual, this happens about every 8 to 10 years. The first Friday of the month is when they report the earnings from the previous run, not the earnings, the previous non-farm payrolls of the previous month. All right. Well, this month just so happens to be Easter is on the first Friday. Actually, it's Good Friday, not Easter, but it's Easter weekend. All right. So that means it's a 3-day weekend. That's what I was thinking in my mind. A 3-day weekend means you've got a major news announcement tomorrow, as well as some other items that come into the news, not just non-farm payrolls. And then the market gets to sit on this for 3 days until the market opens on Monday. Not a good situation, especially when you've got the geopolitical situation with the Iran war that I've previously discussed and you guys know about. So the consensus for tomorrow, Friday, April 3rd, is 57,000. The unemployment estimate, 4.4, staying the same as 4.4. Wage estimation actually up 0.3%. Prior was 0.4. So you can see this is getting softer. Wages estimate year over year, 3.7 versus 3.8. These are not moving in the right direction. They're still positive. We are definitely not in a recession, but it's hard to get these numbers moving forward when we continue to have the political strife we have in this country, which puts people at unease, and certainly the geopolitical situation with bombs going off. And who's even talked about Russia and Ukraine, right? For 4 to 6 weeks. I mean, that's still very much a war in progress. So we have multiple fronts bringing on geopolitical angst, and that affects market participants. All right. So wages and unemployment, Feb wages, 0.4% month to month, 3.8% year over year. Feb wages, 0.8, you can see 0.4, I should say 3.8 above the forecast. Slight deceleration expected, and unemployment holding steady. I think that that's what you're going to see tomorrow. If that happens, I think the market will be a non-event. That's actually our best case, is a non-event for the market. That's definitely our best case. So, all right, what do we have going forward here? Scenarios for the Fed. It's really tough to predict the Fed because Jay Powell is a pretty angry man. He thinks that he should have been renewed for another term. Many people think that he should have been on both sides of the aisle, but that did not happen. So if we have a hot report tomorrow, definitely not any cuts. If we have a cool report, that means the data comes in softer than expected. So unemployment lower, employment higher, inflation lower, expected growth of jobs higher. All right. We're going to have a status quo. And then when the Fed meets again, they do not meet this month. So remember, there are only 10 meetings a year. Actually, I think there are 8 meetings a year, but they're not meeting this month of April. So when they meet May 6th and 7th, there may even be another chairman in place. We do not know that. I expect that's not going to be the case because it does not look like the Senate wants to approve Jay Powell's successor, Kevin Warsh, anytime soon. So what about CPI? This is coming along in a few weeks. Again, we're doing the show a week earlier than normal, so I don't like doing it this far away from CPI. We just had no choice because of our travel schedule. The headline estimate for Feb is 0.3. Feb was 0.3, I should say. The headline estimate for March, well, month over month, 0.5. And why is that? 100%, maybe 96% is because of crude oil. and the rise in price of gasoline because that affects consumer spending. The year-over-year estimate, Feb was 2.4. The year-over-year is estimated at 2.8. Definitely does not please the Fed to see that. All right, the core estimate, 0.3%. Feb was 0.2. So again, we're rising there. These are numbers. CPI is like golf. You always want the numbers to be lower. We want low inflation because it means we can have lower interest rates. Lower interest rates means the money's flowing smoother. If we never had inflation, we would always have low interest rates and business would hum along. But the problem is when business hums along too much, prices inflate too much, and for those people living on fixed incomes, it's devastating, and the Fed jumps in and adjusts the interest rate to drive interest rates down and basically to stop spending or at least curtail it. Okay, so the trend path is still moving in the right direction. If you look on the right-hand side, you'll see that the peak was 9.1% in June of 2022. Feb of 2026 CPI 2.4, so that's an enormous improvement, but the Fed target remains 2.0. Now, I can remember a time just a decade ago when that target was 3.0, but then the Fed realized, 3 is a little hot. Let's make it 2. I wish they'd done 2.5. It would be a whole different environment right now because the difference between 2 and 3 is 50%, right? It's a big deal. So, all right, so the gap to the target, 0.8%. All right. Hey, Deb from South Dakota, I just saw you signed in. Good to see you. All right. I don't see that this is going to be a huge mover, but we will be watching that for you. So the components, obviously energy at the top, shelter is increasing in price, food, beef prices are still high. You should become a vegetarian. All right. But anyway, you do what you want. But the realistic thing is that beef prices are not coming down anytime soon. I know President Trump's been trying to lean on that, but I don't know if there are less cows out there in the fields or what. But beef has been really strong since when Biden was in office, and Trump hasn't brought it down anything significantly. So, and then services ex shelter still hot. So the next release date, April 10th, that'll be in a week from tomorrow, and we'll be standing by to watch that in our travels, and I'll report on it probably in my blog that weekend or my podcast, whichever one you're able to see. Okay, we're in segment 2 right now. I'm going to get a sip of water. I expected this would be kind of a light crew tonight. It is Maundy Thursday or Holy Thursday if you're Catholic. We just didn't have a choice, guys. If I was going to do this live, I needed to do it tonight because we're going to be gone for 7 days. But I hope wherever you are, you guys are getting ready to have a nice weekend and a celebration of Easter. So the feedback that I got from you folks, you clients, is that you would like to see the portfolios reviewed so you know what's going on a regular basis. So the feedback was every month do all 4. Well, the problem is that's a 90-minute show and we'd have people either falling asleep or tuning out. So what we decided to do based on your feedback was a quarterly review. So because it's April, this is the first month of the quarter, we're going to do CG in May, GI, and in June, we're going to do DS and MP, the small portfolio for those smaller accounts. We have clients that don't have the minimum for some accounts, but mainly we have clients that have like an inherited IRA or inherited Roth, and they're just never going to be able to get that account up to the minimum of 125. And so we designed a program with ETFs. We talked about it last month. If you want to go back and see that, you can figure that out and check it out. But today we're reviewing CG in full. So performance, last April was a really difficult month for us, and that's why a trailing year, it's a little bit soft there, maybe a lot soft. But we've made significant changes since then. We moved to Schwab. We now have the put hedges in place. We're starting to use, as of 3 months ago, we're using SPY as the core entity. We'll talk more about that in just a few minutes. So we're really positive about the outlook going forward. When we look at this program in July, which will be the first month of the third quarter, I expect this to look substantially better. All right. The great rotation continues, but we are there. We are positioned for it and ready to make money with it. So this dispersion creates opportunity. I want to take a little bit of time. So the index is kind of hiding the story here. because there are certain stocks, and these are big players that are bringing down the indexes. Microsoft well into a bear market, Tesla in a bear market, Meta in a bear market. And you might say, well, how could it be these huge players? Well, that's one of the reasons why DS is not doing too well, and one of the reasons why the Magnificent Seven is really struggling. But we've seen these periods before. We just posted our performance, by the way, so the April performance charts are there on our website. Just go to CB3 Financials/performance or click the performance button, and it's all there. 7.5-year track record for DS, really, really strong. And actually for all the programs, it's on target for what we're wanting to see. But this dispersion that we see is when these big stocks are down more than the index, and they tend to drag the index down with it because, as you know from previous shows, the Magnificent Seven are 43% of the returns of the S&P 500. So we have to be really razor sharp in the satellites that we place to offset that. We're going to talk about the satellite concept again. I did it 2 months ago. We're going to do it again tonight so that you understand it, okay? So the core satellite structure, this is version 185 for those of you keeping track at home. The core is SPY, that's SPY, that's the S&P 500 ETF. We have 56% of the program in 12 individual positions. That's up from 11. You can see at the bottom there was 11. We added GEV. We'll go into the details on that. We wanted to add some in energy. We have a 3% in the options hedge, which really helped us in March. They're a 20% delta, and they went in the money for a full week because the market sold off so hard and cushioned that fall down below the delta level there. And 1% cash, just keep it there for good measure in case we need it or where we compile dividends. So the satellite count is, I said, 12. You can see that above. We added GEV. The energy exposure is now 7.5%. Options hedge, again, really helped us. The beta of the portfolio. The beta is the volatility of the portfolio compared to the S&P 500. If you want to beat the S&P 500, you have to have a beta that's higher than the S&P 500. But then it means you could lose more than the S&P 500. And that's why we have the options hedging. And because that's why we also choose very, very carefully when we get to these satellites, and we'll go through each one of them right now. So, as I said, we had added one stock. You might say, well, how can you do that? Because you got to come up with the cash somewhere, and we'll talk about that in just a moment. We added GEV, which is GE Vernova. It's a 3.5% position, and it was funded by trimming many of the other holdings by 0.5 to 1% across the other 6 satellites that had gotten actually too large. So as you know, if we have a target on a stock of say 5% and it does really well, it goes to 6%, we retarget that on a monthly basis back to 5% because we want to capture that 1% profit. So that's selling high, right? And then we're going to take that cash and buy something else, presumably lower. And that's exactly what we did this month. So there were no positions exited. All 11 prior holdings were retained, but we do now have this extra position in GEV. So it's a pure play on energy infrastructure, and energy is where we want to be right now. All right. Gas turbines, wind, and grid electrification. Why grid electrification? Because everywhere you look, we are building more and yet more data stations to power this enormous thirst for AI computing. And GEV, I should say, is in a great position to do that. There is zero SPY overlap. Let me talk about this, genuine alpha. When we have a core position like SPY, and both of our programs, GI and CG, have SPY as our core. DS has QQQ. We'll talk about that in June, but right now let's focus on SPY. It's the core S&P 500 holding. So we want to move pretty much with the market for 40% of the time, and then we want to strategically pick stocks that are not correlated to the S&P 500 and gain our alpha there. That's the strategy, and it's been working well since we converted to this earlier this year. So there it is, SPY. It's our core holding, 40% unchanged. It will stay at 40% unless there is a major secular bear market. All right. The Magnificent Seven now represent over 1/3 of index capitalization. And I said earlier, 42% of the return, but 1/3 of the index capitalization. And they cannot possibly be excluded without accepting a structural performance headwind. That is why we made the change to go to this core, because it was clear that those 7 stocks are not going to be shrinking anytime soon, even if they're not always leading, as you just saw in the previous slide, with those 3 Mag 7 stocks already well into bear market territory. At least the other Mag 7 stocks are doing pretty well at this time. So every satellite decision we made was to trim where we could, where stocks had actually exceeded their target. So we took that money and we invested it in a new stock. So number one here, and this is the second biggest overlap we have. So if you can see, it's kind of light blue, but it's there. 1.8% of AVGO or Broadcom is in SPY, but the less the better. And many of these have no exposure at all. So it's on a strong buy signal. VMware integration tracking ahead of schedule and adding high margin recurring software revenue. That's what we want to see. Low expense, high profit margin. That's what major recurring software revenue generates. And the differentiated AI custom silicon exposure definitely means this was a strong hold. BlackRock, the biggest asset manager on the planet. All right, the overlap is less than 1%. We trimmed this 0.5% because, again, it grew at 0.5% over the last 2 months, and we took that profit and put it into the new holding. All 3 channel holdings, and we'll look at the channel in just a few slides up ahead. You guys have seen it many times, but I'll remind you. Their Aladdin risk platform creates deep institutional stickiness. Stickiness is not good when you sit on chewing gum, but when you have clients that have your software and they really would have a tough time leaving it, that's something that you want. Charles Schwab has that. I mean, we're all fully on board with Schwab now, and we're not going anywhere. Those of you that have been with me a long time through 3 broker-dealer changes, we're in a very sticky situation with Charles Schwab, and that's what we want to be, because they are the best broker-dealer by far we've ever worked with. 2.1 dividend, which is pretty amazing for a company this big, and so we used its funds to fund, we used the trim to fund GEV. BWXT also trimmed this from 5.5 to 5, again, just because it's doing so well. The only company commercially licensed to build U.S. Navy nuclear reactors. Read that again. Only company, the only one, it's a monopoly, commercially licensed to build U.S. nuclear reactors, Navy nuclear reactors, regulatory monopoly on critical national security infrastructure. Defense spending increases across the political spectrum. Commercial nuclear renaissance driven by AI data. We love this stock, and a near zero overlap. So it's 0.02, I should say. Great holding. CBOE, the Chicago Board Options Exchange. So this is where all the options trade that are causing this volatility to happen. I think I've mentioned on several shows that the options volume, the notional options volume in America now exceeds the volume of stocks. It's just where people are trading, and the CBOE is by far the largest exchange, and yet it's only 0.05% of the S&P 500. So very little overlap here. We trimmed it. Again, it was at 4.5. It rose to 5. We brought it down. 0DT options remaining about 70% of the volume. We do trade those on occasion, not for your accounts, for mine, but it allows me to keep an eye on what's going on the CBOE. The fact that there's zero overlap enables pure alpha. We love this holding. John Deere, relatively new holding. We kept this the same. We brought it in at 5. It's unchanged. The capital rotation from richly valued tech into real asset businesses is definitely in play. We could have gone with CAT. CAT is actually in the next portfolio, which is GI. You'll see that next month. So we split that up between the 2 programs. It made sense to us. Precision agricultural platform. Look at this, GPS guided planting. I mean, pretty soon you're going to have this thing going along in real time, sensing the moisture in the soil and say, well, you need more rain here and you need more water here, a few less seeds here. I'm not a farmer, so I don't know all of these things, but the technology that American companies are bringing to something that seems pretty sedate like farming is amazing, and John Deere is at the forefront of that. We love this holding. EFA represents all of Europe, so the biggest Europe, and there's obviously 0.00 overlap here. All right, European equities benefiting from fiscal stimulus because those countries over there have to do things to stimulate their economy to be competitive with us. They're increasing their defense spending, and years of having outperformance from the US markets is giving them an opportunity to increase valuations of their European stocks. And also, we benefit from a currency exchange basis because the US dollar is weaker versus the euro and the pound and the Swiss. So we love this holding as well, 5%, pretty good size for CG. GE Aerospace, not to be confused with GEV Verona. All right, GE Aerospace, we trim this, again, doing very well. LEAP engine program powers narrow-body aircraft from Boeing and Airbus. Aftermarket service margins significantly exceed new equipment. There's just everything going right about this. Both of these are spawned from General Electric. So what an enormous company that was, and the spawning of that has done well. Both of these entities, very different spaces, very little overlap here at 0.5%. GEV, I mentioned earlier, this is our new holding. We start relatively small, but this could be at 4 or 4.5 starting on May 1st if it does well. Zero overlap with the S&P 500, a pure play energy infrastructure spun off of GE Aerospace. All right, manufacturing gas turbines, wind turbines, grid electrification equipment, AI data center build out. I mentioned this earlier. Unprecedented demand in modern utility history. Utilities used to be a pretty boring sector, but all of a sudden they're not. With the massive increase needed to power all of these processors, which are made by NVIDIA, that'll be in June's review when we talk about NVIDIA. So zero SPY overlap. We love this new holding. JP Morgan, this is our second biggest overlap. So 1.2% is not much. It's a big percentage, relatively speaking, of all of our satellites in the S&P 500, but 1.2% is really nothing. At 5%, we trimmed it from 5.5 because JP Morgan has done so well this year. So we took some profits there and again, put it into GEV. So investment banking recovered as M&A advisory and equity underwriting volumes increased. Wealth and asset management provide recurring fee-based revenue, reducing cyclicality. Say that 5 times. JP Morgan is firing on all cylinders, doing everything right. Jamie Dimon, remarkable leader. We love the stock. I don't want to say it's a permanent hold. Nothing's permanent. Remember, we date our stocks, we marry our spouses. But right now, it looks like it's going to be with us for quite some time. Palantir, we did trim this significantly, 1 full percent, again, because it has done so well. It's not a conviction change. It's just taking profits when it has basically been an outperformer. So their AIP platform suite continues gaining measurable commercial traction across healthcare, pardon me with my throat here, financial services and manufacturing. Government contract renewals remain steady. Tiny weight in the S&P 500. We love these that have low weights in the S&P because it gives us true diversification. We want a core holding at 4% in SPY, and we want as many satellites as we can have with significance. We're not going to have a 1% or even probably a 2% satellite. We want at least 3 to 3.5, up to 7. All right, Palantir was at 7. We've trimmed it back because we added a holding in GEV, as you know that. But Palantir continues to rock on. And then Rocket Lab, finally, the long-term thesis is intact here. This stock has struggled. It has the smallest weight, but it is the second most frequent orbital launcher globally behind SpaceX. And you know what just happened with the rocket going up and orbiting the moon? Space exploration, even though they're not landing, is still a really big deal. And the companies that can produce these enormous rockets are still very much in demand. So this is a competitor for Elon Musk, and they're doing well. Zero overlap. We like this stock. All right, preserves space economy while sizing to our current strength. So I'd love to see this back up at, 3.5, 4. But right now, not ready to do that. So XLE, this is the largest overlap, 2.5%, and that's because there are so many large energy companies in here. But we needed to do this. We did this prior to the war happening, and I'm really glad we didn't try to, go in and rush and buy it, February 28th, but it got done. So data centers obviously consuming exponentially more electricity, and XLE is the energy sector spider. So think of SPY as our core. XLE is the same sort of ETF, and it becomes the energy sector representative. So rather than having to own 20 or 25 energy stocks, we can own one of them in this ETF. And then we can go seek non-correlated energy like GEV, all right? That's what the whole point is here, is to seek those stocks that are really headed to the moon, but have our core SPY in there to make sure that we are picking up as much as possible the inbred, if you will, response and ballistics of the S&P 500. So there you go. That's the 7.5% with GEV and XLE exposed to energy. This is the chart that we show you. This is our 3-channel chart. So we have the buy signals in those 3 channels, 3 different signals. The first one to trigger goes into the stock. The first one on the downside to get hit and close below the bar is when we exit a stock. Now, if you look carefully, you'll see the big red arrow, and that's April of last year. So now here we are a year later. Had we been able to hedge with options last year, it would have been a very different April for CG, and we're still licking our wounds from that. But now that we're at Schwab, we will never again have that problem. So you see the big red bar at the end. That's the month of March. All right. So it didn't close at the bottom, but it was pretty close. All right. And that's the benefit of having these options. I didn't get a single phone call. And it's okay if you call me, but I didn't get a single phone call because when you looked in your accounts and the market was down 1.5% and CG, as it wore on, the options actually kick in and work more. So we had a day when the market was down 1.7% and CG was down like 0.22. And again, that's because of the options hedging. So this is how it works. We start with what's called a 20 delta, so away from the money. So we're not going to be able to hedge. If you guys wonder, these days we're down 1%, 2%, 3%, maybe even 4%. I'm not seeing really any improvement. The options are not designed for that. They're designed on these big moves down, like 7%, 8%. At 1.9% in the NASDAQ, it never really ended a correction, but the Dow did and the Russell did. A correction is when the market's 10% from the most recent lifetime high. All right, so that's when these option hedges are built to kick in. So our allocation for that is 3%. The status, this went in the money. So these were really cooking with gas for the first time since we've had them in the portfolio since August. So there'll be times when we have these. I'm going to go back to this chart. You'll see that, when that little red bar in February, obviously it got really red in March, but you'll see it kick in there. But when we have these months that are all green, the options are actually losing money. I don't want to mislead you and say that the options are making money every month. They are the hedge. They are protecting us on the downside. So you could say, well, if the market's going straight up and the market's doing 12%, I'm only doing 10.5%. That's probably true. All right. But you're paying a little bit extra so that when the market's down 20, which it hasn't even come close to, then those options are really stepping in and keeping you from a catastrophic loss. Nobody, let's just say at this age, wants to have a 30 or 40% loss. We'll get to this in the income section. I didn't want to jump my gun on that. But nobody wants that kind of loss ever, of course, but they certainly don't want to do it as they enter into retirement. And that's what the option hedging is designed to do. Okay, so this is the summary of version 185. I don't know if you guys keep track of the reversion numbers. They're printed on the reviews on the spec sheets, but there it is. There's everything I just talked to you about. 12 satellites now instead of 11, 3% hedge, 6 themes, meaning we have energy, we have tech, we have financials, we have banking, we have agriculture, we have trading, if you will, with SIBO. And then Rocket Lab with basically defense. So there's 6 themes for you. That's the strategy. So this is our first quarterly review for CG. The next one will be July. The next one after that will be October, and then January. All right. And in the second month of every quarter, it will be CG. You can see down below next month. And in the third month of every quarter, it will be DS and MP. All right. I'm going to rest my voice for just a minute and see if you guys got any questions. Okay. Hey, John, good to see you. Hope you're feeling better. And happy Easter to you too. All right. I appreciate you guys being on here. I see it's a pretty small crowd tonight. And I had at least a dozen people say, yeah, we got to go to church tonight. And actually, we'll be there tomorrow night. But tonight we're here. So wanted to be in touch with you guys with what's going on. So we've had, I don't know, 8 clients in the last 4 months say, we're getting close here. What about transitioning to income and how do we handle that? So here we are. Certainly the discussion of transitioning to income is important to all of us, but it's important at different times. First of all, we have clients that have significant assets with us and assets at other managers, and they might have their income assets with those other managers. So they'll just stay with us with growth all the way through because they don't expect to pull from our accounts that we're managing for them because we're kind of known as a high growth company. But we definitely handle income. Alice and I, as you know, trade all of our programs, and we're eventually going to retire. Not sure when. But we will, and we have to have this same strategy for ourselves, which we do. So let's walk through this. Converting growth portfolios to income engines. When the goal shifts from building wealth to living on it, the portfolio must evolve, and this segment shows you how we do that. So here is the transition. The challenge: you've spent decades building wealth through growth-oriented equities. The retirement shifts the goal from accumulation to distribution. You've built the wealth, and now you're going to distribute it to live on. Simpler way to say it, I suppose, is all your life you've worked for money. Now your money's going to work for you. It's going to be your employee, and we're going to help you get there with that. All right. So the wrong transition obviously can lock in losses or sacrifice years of income. This is a discussion that's unique to every single person here. There's nothing that I'm saying in this segment that applies to everybody. When I'm talking about CG and GI and non-farm payrolls, that applies to everybody here. But the income transition is unique to every client that we have. Okay, so the tax efficiency matters, especially if you have money outside of IRAs. Many of our clients have the predominant amount of their wealth, and we do, Alice and I do, in qualified accounts, meaning IRAs and Roths and SEP accounts. We also have a pretty good sized trust, but we have clients that have nothing but qualified accounts and have clients that have nothing but non-qualified accounts. So our approach is a phased transition, not just a single switch. In this year, you just throw the switch. You can't do that because, again, that would be market timing. It's just another flavor of market timing. All right. So our core satellite architecture naturally supports that shift. And GI is our growth and income program and is purpose-built for this exact transition. The put spreads that are in SPY, that are also in GI, just like they are in CG, help protect during this vulnerable transition period. And we're always adapting. That's why you have us here. So your transition starts here. We assess, and this is when I talk with each of you, and many of you, we've had these conversations, but it's a good idea. I pretty much know the age of you guys. I know your employment situation, and I would be reaching out and saying we need to have this. But if you want to start sooner after you've watched this, that's just great with us. All right, so you review the current portfolio. Now, when I say portfolio allocation, if you have 3 of our programs and you have, some people have 7 accounts. They got 2 in CG, 2 in GI, maybe 1 in DS and 3 in MP, whatever it is. And some have discretionary portfolios. All right. We just need to look at that composite. That's called the portfolio. CG, GS, GIDS are programs. All right. So there's the syntax to keep that straight. So identify the retirement timeline, calculate the income gap needed versus current yield, and then map all the income sources. So we'll sit down, and this is where eMoney comes in, and maps your income to your expected Social Security, your expected pension, any other income you have, rental income. We have clients that have farm income. Need to look at all of that, all right? And then see what your income structure is going to be. And then build a personalized glide path schedule for you per person. All right, model the tax impact. Of course, we can't predict taxes any more than we can predict what's going to happen in the market, but we can at least model it based on current tax structures. And that would be state income as well as federal income. If you're blessed enough to live in Florida or Tennessee and other places like that, you know, you don't have state income, obviously Montana, New Hampshire, et cetera. But for most of us, we are paying state income tax as well, but not necessarily on retirement assets. So that's a discussion to have. All right, establish the hedging strategy for transition so that you understand that, and then execute this. Quarterly check-ins, monthly rebalancing. We decided we were going to have monthly rebalancing on the programs, but we will rebalance your overall portfolio with the programs on a quarterly basis if need be. All right. So our signal-driven adjustments, obviously, you know, but you saw the channel. You've seen it many, many times. We have a very sophisticated 3-channel buy-sell engine that tells us when to buy, when to sell. Not so much the quantity, but that's a matter of risk. That's a different discussion. But so the question that all of you ask, every question that every client eventually asks me is, I've been growing my portfolio for decades. Now I need it to pay me. How do we make that transition without blowing up what we built? That is a great question and a very important question. So in the accumulation phase, we're growth focused, right? Maximizing total return, all right? And that's total risk adjusted return, just so you know. Tolerate volatility. How do you tolerate volatility? You probably have a higher tolerance in the accumulation phase, less in the distribution phase. Okay, you're reinvesting dividends. You're not living off them a time horizon 10 to 30 years. We don't have many clients that have 30 years left to work. We have some that have 20. All right, so they're not really too concerned about this segment, but at least you know we're thinking about it and ready for you. But we do have many clients in our age bracket that are getting ready to start drawing on their portfolios. So income focused, generate reliable cash flow, minimize sequence of return risk. We're going to talk about that in just a minute. Preserve capital, and the time horizon is now when you reach that point. Okay, I can see my voice is failing me, guys. We have had really difficult weather here in Chicago, so I'm going to get through this, but if my voice peters out, just have patience, please. So phase one, not all of our clients, but I'd say 80% of our clients are still in this because even if they're my age, they're still working or they're living off other assets. And at this point, they're still heavily in growth programs. So our CG and DS programs. All right, phase two, 5 to 7 years. For some people, it's 2 to 3 years ahead of pre-retirement because they're willing to stand a higher level of risk. I would suggest that you talk with me on this because you may be closer than you think. You may have a sudden job loss, a change in your retirement time frame, and if you just stay invested in full growth, it could be to your detriment if we have a year like 2008 that has a major downturn. Even with the options, we're going to be down in a year like 2008. All right. Phase two is when to look at Roth conversion. Many of you have Roths with us. Many of you have Roths plans that you haven't executed yet. And obviously this is something we get involved in with your CPA. But the program during these two programs, CG and GI, not so much DS when you're in this pre-retirement. And then I wouldn't say everything in GI. It depends on the amount of assets that you have, but you may still have a CG account. We have clients that are in full retirement, again, that have large accounts that have both CG and DS. Alice and I have CG and DS, even at our age. But that's because I watch the markets all day long. So this is when we really fine tune on your risk tolerance, okay? Knowing that distribution is either imminent or now. So from where is the income derived? Dividends, 1 to 3%. There was a time when companies were paying 4, 5, 6% dividends. To get that kind of dividend now, especially in the financial sector, you're taking a lot of risk in the company with a company that's not growing at all, and they're just holding on tenaciously to their dividend. And what happens is eventually their stock goes down, they don't have the cash to pay the dividend, and they just cut the dividend, and then everybody exits that stock and it's just a colossal loser. So we don't tend to go for those. We're looking for strong dividends from BLK, JPM, JEPI, JEPI. All right. And then bond yields in GI, obviously 4 to 6%, Brooklyn, HYG, Scooby, pardon me for my acronyms here, SGov, IGSB. That's the hallmark fixed income, FI stands for fixed income sleeve of the GI program. And then variable options. So this isn't hedging. This is actually a different strategy that's employed in this asset JEPI, which is right now in the MP program, but it gets moved into a custom portfolio when you are basically living on 80% of your assets. And we don't have too many clients doing that. And I think, again, because we have pretty much been known as a growth manager, and a lot of people have their income outside, or they're just living off their savings and Social Security and waiting to draw in later life. Some clients, again, this is now it gets into an estate planning issue. We just want to leave our assets to our kids. We don't ever want to spend it. That's fine. I get that. But that's a discussion we should have. And it's totally apart from us managing CG, GI, DS, MP for you. All right. So the key insight here, though, is income doesn't mean sacrificing growth. You still need growth. Why? Because of inflation. If I just put you in T-bills and you pulled out 4% a year, and we have another 1979 to 1987 inflation run, hope you like ramen noodles. I mean, that's just the reality. Not where you want to be. You have to have some growth. All right. So these are the buckets. And this isn't original. This is, what we call them, but basically it's 3 places to place your money, right? It's not in our programs, but the money that you are going to be needing for the next 2 years, you should have in cash, short-term fixed income, money market, SGov, IGSB. And that is so that you do not need to come to us and get income. Now, you can come to us. We have portfolios that are set up that are not part of our standard menu, where people are just comfortable having income basically in ETFs and treasuries, and we just feed that income to them every month, and that's fine, or quarterly. All right. But you should probably want to have a chunk of money outside. I know it seems crazy for me to advertise having money away from us, but we're not here to just try to maximize our management fees. We're here to have you set up to what makes you best suited for retirement. Okay. So bucket 2, soon, 3 to 7 years. That's the income oriented 2 GI. That's the first account that we're going to pull from. So we have clients that have transitioned from CG to GI portfolios, and they are basically drawing income from that. And eventually that GI account will be extinguished. Maybe not for many, many years, because right now they're pulling out at 4%. We're going to talk about that in just a few minutes. What's the comfortable withdrawal rate? They're pulling out, and the market's been growing at a high enough rate that they're not drawing down the account. That's a great situation to be in. All right. So dividend yield, fixed income sleeve, that's what comes from GI. And then bucket 3 is for later. So you still want to have CG and or DS. Why? Because of the maximum long-term compounding. This money has time to recover. So you say, well, I'm 70, I'm 75. All right. I'm not going to need any of that money. Yeah. I just saw Warren Buffett interviewed on CNBC. I won't say sharp as a tack, but sharp as a pretty sharp tack at 95. He didn't stumble on a single answer. He had to take a little time to answer some, but 95? Are you set to make it till 95? Now, if you could just tell us, as your not only portfolio manager, but as your financial manager, financial advisor, your death date. For years when we taught classes, I tried to encourage people, if you would just commit to a death date, it would make everything simpler for you, your beneficiaries, for us as your manager. I have not had one single client be willing to commit to a death date. I wonder why. All right. But if you do live longer than you think you might, you have to have money invested as if you were 30. So let's say you're 50, all right, and you want to have, pretty good growth, but then you want to have some outrageously aggressive money, for when you're 70. Well, when you're 70, you might want to have some outrageously aggressive money for when you're 90. And then that portfolio becomes GI or the equivalent 15, 18 years from now. All right, you see how that works? The buckets kind of move along. Let's go back and look at those again. So the money that's in the 8+ years, bucket 3, can pour into the income soon, 3 to 7 years, and then that money, you take profits from that and put it in bucket 1, 0 to 2 years. So if we have another 2008, another 2001, you really don't want to reach into those growth programs because they're going to be in a downturn. We can help you with all of that. All right, that's what you're paying us to do. So the sequence of return risk, this is a pretty big deal. That's why it's highlighted. We're going to have a slide just on that coming up here. Inflation erosion, I mentioned this earlier. You have to have assets in growth. You can't just have income assets. Americans are living longer. A 30+ year retirement is increasingly common. And tax bracket shock. Hey, RMDs, Social Security, pension income can push you into higher income brackets. Be aware of what your tax bracket is. It's really important that you're meeting with your CPA at least annually, preferably twice a year, so that you are preparing for that. All right. So our protections, the put hedging, which you've heard many things about, are very systematized 3-channel buy-sell signal engine, dynamic rebalancing every month, and then tax loss harvesting. For those of you that have trust or other non-qualified accounts, that is a regular service that we provide for you. So this sequence of returns, what does this mean? It means, when do you want to retire? Well, you want to retire in 2013 and not 2008. Why? Because 2013 was the beginning of a secular bull market. 2008, as you know, was a horrible downturn. How do you choose that? You don't. And that's why it's a really big risk. You don't want to retire in a bad year, but you can't control that. So how do we help you with that? First off, you have to make sure that this transition really matters and you understand it. You can't afford to be in 100% growth when the cash flow starts. So we need to transition gradually from your growth allocation to your growth and income allocation. All right, build this cash cushion that we talked about, maintain the growth allocation for the portion that you won't touch for 5+ years. That's the third bucket that I mentioned just in the previous slide, okay? So the multi-program structure was designed for exactly this transition. Dividend-paying equities, the REITs, aristocrats, high-yield ETFs, that's all in GI. Fixed income bonds, option premium, that's the JEPI, the JEPE ticker symbol that I showed you. Obviously, Social Security optimization, delaying versus taking early claims. The longer you delay, if you can delay till 70, you should. Mostly, I can't give you that advice on the phone per person, but most people should do that if you can. And then systematic withdrawals, 4% rate of withdrawal. This is really important. A lot of people say, well, in a big year, can I take more? You absolutely can. All right. So if you have a 15% year and I was only going to take 4, then I want to take 12. I wouldn't do that because the next year could be really bad. But if you want to go from, say, 4 to 7 or 8, you absolutely could. All right. And we would be glad to help you do that. All right. And yes, it does lower our management fee, but that's okay. This is all about you, not about us. All right. But 4% is the target. For every $100,000 you have invested, plan on taking $4,000 of that. So that's $40,000 on $1 million portfolio, meaning all of the programs you have with us and with anybody else, plus Social Security, plus pension. And all of a sudden, you're at $150,000 a year. Pretty good, passive income retirement year. So this is, again, why 2GI has been built. A 60-40 allocation, a little aggressive right now at 68. 32. All right. 2.5 dividend yield, 4% is the target range. We're pretty much there. All right. So dividend aristocrats like JPM, Avago, Broadcom, I should say, the SPY hedging, monthly rebalancing to maintain that income target. So when we have a stock that has paid dividends, we're going to rebalance that so that those dividends get put into cash and that you can withdraw them if you need them, if that's the structure that we set up for you. So this 5-year glide path, I realize some of you are going to need to watch this twice, and that's okay, but there's a lot here. So year 1, maybe where you are now. Year 2, modify. I don't have very many people that will go through this 5-year, this granular 70-30, 60-40, 50-50. But if you want to, and you have your accounts registered in a way that can be done. So if you have all of your money in IRAs, it's really simple to do. But if you have some money in IRAs, some money in SEPs, some money in Roths, some money in trusts, some money in individual accounts, it's hard. That money's not all fungible because of what's called the registration. The IRS treats them differently. So again, that's a one-on-one conversation, okay? So the bottom line on this is, though, transition gradually, never liquidate, and this is rare time to say it, never liquidate a growth portfolio in a single tax year. We would not let you do that, okay? So GI is the only program we have that is actually positive for the year. When the market was down 7.5%, that we were up about 1 3/4, a little less than that on March 31st. We were really proud of that. All right. The goal is to not have the volatility in that program that we do in the others, because you have time to recover in CG and DS. You may not have as much time to recover in GI. Although realize it's still not your first source. For most people, they're going to be pulling from CDs and other immediate term, short-term paper notes, treasury bills, etc. But CG is next in line. And for many people, they just pull it from GI. Right? Or we hold a portfolio of T-bills for them and just feed them the income so they don't have to be concerned about it. All right. 30% fixed income sleeve is doing exactly what it's designed to do, generating positive returns while the broad market sells off. Only in 2022 did both stocks and bonds go down. It's the only year in the last 20 some years. Probably won't happen again in my lifetime. Maybe I should say maybe won't happen again in my lifetime, but generally speaking, stocks and bonds have reverse correlation, and that's a good thing. That's what we want to see. So your next step, if you're 5 to 10 years from retirement, let's talk about this. Let's have a conversation, not when you're getting ready to retire next month, because who knows, we might have a termination slip that you didn't predict. We'll look at this custom allocation. We'll put it in your financial plan so that you're at least understanding it and can reference it. If you're already in retirement, let's make sure we're maximizing the amount of income that you can safely take. That does not mean, again, as I said earlier, don't ask for a 7 or 8% withdrawal rate. I'll do it. It's your money, but I definitely will have to have you sign off on it. All right. Because safe withdrawal rate has been mathematically tested now with AI hundreds of thousands of times. 4%. It's probably like 4.0163 or something, but we'll call it 4%. And in a good year, yes, you can take more. Just because there's a war zone outside doesn't mean it has to be a war zone inside your portfolio. Guys, that's it. Thank you for watching tonight, especially because it was a week earlier than normal. It will be 6 weeks before the next show. That's just because of the way the timing works. But I have my podcast. Hope you guys are listening. I'm seeing increased traffic. I'm glad to see that. Tune in on Spotify or Amazon, YouTube, and Apple, of course, or anywhere that you get your podcast. We are publishing there. Our next show, as I just said, is Thursday, May 14th. That's halfway through the month already. And here we are in the beginning part of April. There'll be a lot of earnings information to discuss with you. And I sure am hoping we will not be in the Strait of Hormuz if President Trump is, in fact, straight shooting with us. This needs to get solved for everyone's benefit. Any questions, type them in the chat. But I thought this quote was appropriate for this particular time here. In the midst of chaos, there is also opportunity. I'm going to insert the word great. There is great opportunity. Sometimes it's to rebalance. Sometimes it's to rethink. Sometimes it's to reformulate your plan. Sometimes it's to take profits in stocks that have done well in CG and take that little bit of cash from a few different stocks and put it into a new holding. And that is what we did for you guys. In summary, and this is never more important than Holy Week, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. 2 Timothy 1:7. We so appreciate all of you guys. This has not been an easy start to the year. We understand that. We've got you covered. I sleep better knowing that these options are in my account and in your account. We've got a built-in hedge against whatever may happen in the Middle East, and who knows, that could get solved and then Russia decides to play even more aggressive with Ukraine, or who knows what could happen. The point is that we want to be prepared for anything in our portfolios, and we try to explain how we do that on your behalf on these monthly shows. If you know somebody that's interested, tell them. We'd love to have them watch the show. We'd love to build our audience. All right. You guys have a wonderful Easter weekend, a wonderful next 6 weeks. God bless you, and we will see you soon.